On the surface, November 15th, 2024 looked like any other slow news day. Markets drifted sideways, cable news argued about elections and celebrity scandals, and most people went to bed thinking tomorrow would look just like today. But in the quiet corners of global finance, on the screens that don't make it to CNBC, something snapped. It didn't start with a headline. It started with a number. In a window almost nobody outside the financial world has ever heard of, foreign custody holdings at the Federal Reserve. A line that had been fairly stable for years took a sudden, vicious turndown. Not by a few billion, not by some tiny adjustment. In a matter of hours, the equivalent of hundreds of billions of dollars in US treasuries began to vanish from the ledger. At first, it looked like a glitch, a bad data feed, a timing mismatch. But then the same pattern started showing up in Europe, at Euroclear, at offshore clearinghouses, in the balance sheets of obscure sovereign wealth funds and anonymous investment vehicles that insiders have quietly linked back to Beijing for years. The same pattern, massive blocks of US. Debt quietly being exchanged for cash, commodities, and non-dollar assets. By the time the sun rose over New York, the models that track global capital flows were blinking red. When you added up all the pieces, the treasuries moved out of official Chinese accounts, the bonds dumped by friendly central banks, the positions liquidated by Chinese-linked funds. The total wasn't a rumor anymore. It was a number. $3 trillion worth of US exposure being unwound, not with a press conference, but with a scalpel. Officially, China hadn't announced anything. The People's Bank of China didn't hold a televised briefing. Beijing didn't declare economic war. But behind the silence, the pattern was impossible to ignore. They weren't just rebalancing their portfolio. They were walking out of the dollar system with the calm, deliberate speed of someone leaving a burning building before everyone else smells the smoke. You didn't hear about this on the evening news. There were no emergency specials, about $3 trillion in capital quietly fleeing US debt markets. But if you were watching the right data, if you understood how global money actually moves, you could see it. A slow-motion bank run on the dollar, led by the one country the United States could least afford to lose. And here's the part that should scare you. This wasn't a spontaneous panic. It was coordinated. China didn't just wake up one morning and decide to hit sell. They've been preparing this move for years, building the pipes, making the deals, accumulating the collateral. November 15th wasn't the beginning. It was the reveal. Most people went to bed that night thinking they were still living in the old world. A world where the dollar was untouchable, where treasuries were risk-free, where America could print and borrow forever. But by the time they woke up, the foundations of that world had shifted. And if you're holding dollars, if your savings, your paycheck, your retirement are all tied to that green piece of paper, you need to understand what China just did and what comes next. Because $3 trillion doesn't move by accident, it moves with intent. And that intent is simple: to end the age of the dollar. To understand why China's move matters, you have to understand the game the United States has been playing for the last half century, and the cheat code that made it all possible. For decades, the dollar hasn't just been America's currency. It has been the world's operating system. When Japan buys oil from Saudi Arabia, the contract is in dollars. When a German company imports copper from Chile, the payment is in dollars. When central banks want a safe asset, they don't stack euros or yen, they buy US treasuries. This didn't happen by accident. In the early 1970s, after President Nixon severed the last link between the dollar and gold, the United States struck a deal with Saudi Arabia. Sell your oil only in dollars, and we'll protect your kingdom. Other producers followed. If you wanted energy, you needed dollars. If you wanted dollars, you had to either sell something to America or park your savings in American debt. That was the birth of the petrodollar era. For the United States, it was the greatest financial privilege in human history. While other countries had to produce cars, machines, and raw materials to earn dollars, America could simply create them. We printed the world's reserve currency, and the world happily absorbed our paper because they needed it to trade, to save, to survive. Our deficits didn't matter. Our wars didn't matter. We could borrow endlessly at low rates because every other country on earth was effectively forced to fund our lifestyle. But there was a catch, one that politicians in Washington conveniently ignored. The system rested on a fragile, intangible thing: trust. Trust that the United States would not abuse its power. Trust that the dollar would remain relatively stable. Trust that the rules of the game wouldn't be changed whenever it suited Washington. Instead, we did the opposite. We printed trillions to bail out Wall Street, trillions more for stimulus, trillions more for endless wars, and promises no one bothered to properly fund. We ran deficits like there was no tomorrow, and told ourselves the world would always swallow our debt because, well, we were America. And then we used the very system everyone depended on as a weapon. Don't like a government? Cut it off from the dollar. Don't like a country's foreign policy? Freeze its reserves. Don't like how a rival behaves? Disconnect its banks from the global messaging network and starve it of liquidity. The dollar stopped being just a measuring stick and became a club. You might cheer when that club is swung at your enemies. But if you're another major power, say China, you watch closely and you ask a simple question. If they can do that to Russia, what happens when they decide to do it to us? While Washington lived in the illusion that the dollar was untouchable, Beijing took notes. They saw the money printing. They saw the sanctions. They saw the political dysfunction. And quietly, patiently, they began to prepare for the day they would no longer be trapped inside a system someone else controlled. November 15th was the day they stopped rehearsing and stepped onto the stage. The sell-off wasn't just about bonds. It was a vote of no confidence in 50 years of American monetary arrogance. And it was the first visible move in a plan that reaches far beyond treasuries and interest rates, a plan to replace the very system that made the dollar king. You can't walk away from the dollar without a backup plan. China knows that. That's why their $3 trillion exodus is only one piece of a much larger puzzle. A puzzle they've been assembling for more than a decade, while Western leaders congratulated themselves on winning the 21st century. Start with alliances. China didn't just sit alone and complain about the dollar. It built BRICS into a serious counterweight. Brazil, Russia, India, China, South Africa. A bloc representing a huge share of global population and real production. Then came the next wave. Saudi Arabia, the United Arab Emirates, Egypt, Iran, Ethiopia, and a waiting list of over 40 nations eager to step into a world where Washington can't unilaterally pull the plug on their economies. Think about the symbolism of that. The very country, Saudi Arabia, that helped create the petrodollar system, now sitting at the same table as China, in a club openly discussing ways to trade without dollars. That's not a theoretical shift. That's the ground moving under the old order. Then there are the pipes. While the West fixated on SWIFT and our payment rails, Beijing quietly built its own alternatives. The cross-border interbank payment system, bilateral swap lines with dozens of central banks, direct currency agreements with Russia, Brazil, Pakistan, and beyond. Little by little, the world's second largest economy has been teaching its partners how to trade around the dollar, not through it. Layered on top of that is something even more fundamental: gold. Publicly, China admits to a few thousand tons sitting in official reserves. But anyone who follows shipments, mining output, and the flows through Shanghai's gold exchange knows the numbers don't add up. Private refiners, state-linked banks, and sovereign funds have been hoovering up metal at a pace that simply doesn't match the official disclosures. The best estimates put China's true hoard at some multiple of what they admit, possibly rivaling or exceeding the stash the United States claims to hold. Why does that matter? Because paper currencies come and go, but for 5,000 years, gold has been the final reference point, the thing people flee to when trust evaporates. If you want to build a credible alternative to a fiat dollar drowning in debt, you need something solid under the floorboards. China knows this, so do its partners. Now imagine this sequence. Step 1, Exit dollar assets quietly, while you can still get a decent price. That's the $3 trillion exodus. Step 2. Deepen trade links, swap lines, and payment systems that don't touch the dollar. Step 3. Make the announcement. Not a Hollywood-style speech declaring the dollar is dead, but a calm, technocratic policy note. Maybe China reveals a more honest number on its gold reserves. Maybe BRICS rolls out a settlement unit explicitly linked to a basket of commodities and metal. Maybe Beijing announces that large foreign holders can, under certain conditions, convert yuan into gold at a fixed window price. They don't need to make their currency fully gold-backed in the old-school sense. They just need to offer a path, even a narrow one, from paper into metal. Compared to a dollar backed by 30+ trillion in debt and political dysfunction, a yuan with even a partial gold anchor suddenly looks sane. When that happens, central banks around the world will face a choice. Stick with a system run by a country that weaponizes its currency and can't control its own spending. Or start migrating reserves, trade contracts, and savings into a network where money is tied, even loosely, to something real. China's message is simple. You've seen what the dollar has become. We're offering you a lifeboat. You don't have to jump all at once. Just start moving a little and see how it feels. The $3 trillion they just moved was them getting into the lifeboat first. All this might still sound abstract. Payment systems, gold reserves, central bank flows. It's easy to think, okay, that's big picture stuff. But what does it actually mean for me? So let's bring it home. Right now, the reason the US government can borrow at relatively low rates, despite drowning in debt, is because foreign countries need treasuries. They need dollars to trade. They need safe assets for their reserves. That constant demand keeps interest rates artificially lower than they would be in a normal market. It's like having a credit card where the bank keeps offering you more limit, no matter how badly you manage your finances. Take away that demand, and the math changes overnight. When China sells instead of buys, when BRICS countries start settling trade in their own currencies, when oil contracts are written in something other than dollars, the US Treasury has to work harder to convince buyers to show up. The only way to do that is to offer higher interest rates. Higher interest rates at the government level filter down to everything you touch. That 30-year mortgage that was expensive at 7%, try 15. The car loan your dealer stretched to make affordable, doubled. Credit cards push into the 30s and 40s. Any business that depends on borrowing, from the restaurant on the corner to the manufacturer in the Midwest, suddenly finds that financing isn't just painful, it's impossible. Housing stalls, then cracks. Small businesses close. New projects never break ground. Unemployment starts to creep up, then lurch higher. This isn't a gentle slowdown. It's like slamming the brakes on an economy that's built on cheap credit. At the same time, something else ugly happens. Reverse dollar flow. All those dollars that have been parked overseas, in foreign banks, in reserves, in offshore accounts, become less desirable as the world shifts to new settlement systems. Those dollars don't just vanish. They come home. Trillions of them. Now picture that tidal wave of returning money crashing into an economy that hasn't suddenly started producing more goods and services. You've got a lot more dollars chasing the same amount of stuff. You don't need a PhD to know what happens next. Prices start sprinting ahead of your paycheck. Forget the 8 or 10% inflation headlines we've seen. In a true reserve currency crisis, numbers go parabolic. Grocery bills that double in a year. Rents that jump every few months. Savings accounts that feel like they're melting. Retirement plans that were built on the assumption of normal inflation get blown apart because the entire reference point, the currency itself, is collapsing. Meanwhile, America's standard of living adjusts downward, hard. For decades, the United States has been able to import more than it exports, consuming more than it produces, because the rest of the world was willing to accept dollars as payment. That's why we've had cheap electronics, cheap clothes, cheap everything from abroad, take away dollar dominance, and imports stop being cheap. They get priced in stronger currencies, or they get priced in commodities and gold-linked units that don't care about Washington's political needs. Suddenly, your phone, your clothes, your basic groceries no longer feel normal. They feel like luxury items. You don't just lose money, you lose purchasing power, which is the only thing that actually matters. And looming over all of this is the federal balance sheet. More than $35 trillion in debt and climbing. When interest rates spike and the dollar weakens, the cost of servicing that debt explodes. The government is forced into impossible choices, spending on Social Security, Medicare, defense, and everything else people rely on. Or lean even harder on the printing press and risk turning bad inflation into outright hyperinflation. Either path leads to social stress, protests, political chaos, a sense that the future is no longer something you can plan for, only react to. That's what a reserve currency crisis looks like from the ground. Not just numbers on a screen, but pressure in your daily life. At the gas pump, at the grocery store, in your mortgage payment, in the way your kids think about their own future. China's $3 trillion exodus wasn't just a technical adjustment. It was the starting gun for a race most Americans don't even know has begun. Here's the most dangerous part of all this. It doesn't feel like a crisis until it already is one. Currencies don't usually die in a single day. They erode, slowly, at first, then all at once. 1 year, you notice your dollars don't go as far as they used to. The next, you hear about a few more trade deals being settled in alternative currencies. The year after that, you catch a headline about some central bank trimming its dollar holdings and adding more gold. Individually, none of those things trigger panic. Together, they form a pattern. If you zoom out, you can already sketch a rough timeline. 2025. More trade deals bypassing the dollar. More countries formally joining BRICS or aligning with its payment networks. More central banks nibbling away at their treasuries and adding to their gold piles. Official narratives still insist the dollar is strong, but the data doesn't quite match the tone. 2026. A moment. Maybe it's China revealing a shockingly high gold reserve number. Maybe it's a formal BRICS settlement unit tied to commodities. Maybe it's Saudi Arabia signing its first major oil contract priced in something other than dollars. Whatever the trigger, this is when the wider financial world starts to say out loud what insiders already know. The dollar's share is shrinking, and it's not coming back. 2027 and beyond, volatility becomes the new normal. The dollar's decline accelerates. Inflation refuses to go back in the box. Interest rates jerk around as policymakers try to balance defending the currency with avoiding a complete economic seizure. Investors swing wildly between fear and greed. Political rhetoric turns more extreme as leaders search for scapegoats. Some people will still call this fear-mongering. They'll say, the US is too big to fail. The world has no alternative. This has been predicted for decades and never happened. They said the same things about housing before 2008. They said the same things about every empire's currency before it slid into history. Meanwhile, the people closest to the money, hedge funds, family offices, ultra-wealthy insiders, won't waste time arguing on TV. They'll just move, quietly. They'll sell bonds while there's still a bid. They'll rotate out of dollar-only assets. They'll set up accounts abroad. They'll buy farmland, energy stocks, precious metals, infrastructure plays, and anything else that doesn't depend on the Federal Reserve's promises. By the time the average person realizes something is wrong, the exits will already be crowded. The best opportunities will be gone. The safer havens will be more expensive. The families who had the most to lose will have positioned themselves. The families who had the least room for error will be the ones standing under the avalanche. That's why China's move on November 15th matters so much. It's not just a data point. It's a signal. A public, measurable sign that the players who understand the game at the highest level are no longer willing to hold the old world's liabilities. You can choose to ignore that signal. You can choose to believe that somehow this time the math won't matter, or you can treat it for what it is, an early warning siren in a world where most of the alarms have been turned off. The timeline isn't measured in decades anymore. It's measured in years, maybe even less if a major shock forces everything to move faster. The question is not whether the transition away from dollar dominance is happening. It is. The question is whether you're going to drift into it unprepared or walk into it with your eyes open. If all of this feels overwhelming, that's normal. You're not supposed to think about the plumbing of the global financial system. You're supposed to go to work, pay your bills, and trust that the experts have everything under control. But the experts are the ones who built the mess we're in, and they've already taken care of themselves. So what do you do if you're not a central banker, not a billionaire, not sitting on a private jet ready to hop to the next jurisdiction? How do you protect yourself and your family from a slow-motion currency collapse? First, you stop thinking of cash as safety. A savings account full of dollars might feel comforting, but in a world where the value of those dollars is being actively diluted, safety becomes an illusion. You still need cash for day-to-day life and emergencies, but as a long-term store of value, unprotected dollars are a melting ice cube. Second, you start moving a portion of your wealth into things that can't be printed: physical gold and silver, not a line in an ETF prospectus, real metal you can touch, stored somewhere secure. Precious metals have outlasted every monetary experiment in history because they don't depend on anyone's promise. In a world where China is quietly tying its future to gold, owning some yourself isn't paranoia, it's common sense. Third, you look at real assets: land, productive property, businesses that create something people actually need. A small farm, a rental property with sensible financing, shares in a company that produces food, energy, or essential materials. Will these investments be perfectly smooth in a crisis? Of course not. But they're tied to reality in a way that paper promises are not. Fourth, you consider a measured allocation to alternative systems, whether that's foreign currencies in more stable jurisdictions or even a cautious slice of cryptocurrency. Not because any of them are magic, but because every layer of diversification away from a single failing system buys you time and options. Fifth, you pay brutal attention to debt. In a world of rising rates and unstable currencies, variable rate debt is a trapdoor. You do everything you can to reduce or eliminate it. You refinance into fixed terms if it makes sense. You stop assuming you can always roll it over later, because later is exactly when things tend to break. Sixth, and maybe most importantly, you invest in the only asset no government can tax away or print into oblivion: your own skills and relationships. Learn to do things that matter in the real world. Grow food, fix things, provide services people will need no matter what happens to the dollar. Build a network of people you can trust, trade with, and support. Money is powerful, but when systems crack, community is what determines who weathers the storm. None of this requires panic. It doesn't require bunkers or doomsday fantasies. It requires something much harder: accepting that the world you grew up in is changing, and that no one is coming to save you from the consequences. China's $3 trillion exit from US assets is not a rumor. It's not a plot twist in a movie. It's a move on the board in the biggest financial game humanity has ever played. The people at the top are already adjusting their positions. The question is whether you will adjust yours. You don't have to do everything at once. You don't have to become an expert overnight, but you do have to start. Start learning. Start reallocating. Start talking to your family about a future where just hold dollars and hope is not a plan, it's a liability. The window to act is still open. China moved early. The elites moved early. Regular people still have time, not a lifetime, not a decade, but time to shift from being victims of this transition to being survivors of it. What you do with that time is up to you.